I'm here in Sweden, where I've been speaking to an international conference of senior leaders talking about global trends. And one key issue is this: will the European Union survive? Well, according to a poll of hands here, certainly most of the people in the audience think that the European Union may not. And they think that there may be a 30% or more risk that the euro will break up, that a country will be thrown out, whether it likes it or not. So what is all that about, and why has it happened, and what's going to happen next? Well, it's all part of the aftermath, of course, of the subprime crisis. When the American mortgage crisis first developed and then started to sweep up all kinds of institutions in the chaos, governments responded by printing money, stimulating their economies, pouring money in all kinds of ways to try and prevent a catastrophe, which largely happened. And through 2008, 2009, we had relative stability despite what many experts were saying was likely. Now, of course, the chickens came home to roost in 2010 when governments realized just how much debt they'd mounted up in those rescue processes, or rather the analysts did. And when they started looking at the capacity of those governments to repay those debts, they really started to worry. The trouble is that many governments need to sell their debt on the open market every year. They need to sell billions of dollars of government bonds or euro bonds or whatever their currency is. And if the analysts are worried about the solvency of that particular country, then they demand more interest because they're afraid that they're going to lose a lot of that money if there's a default. That means that the interest rates on those bonds need to rise, and that means the cost of borrowing goes up in future for that country, not just in terms of borrowing more money, but in terms of recycling the debt that it's already got, because of course many of the bonds they've got were for fixed terms, so they expire after 5 years. The money has to be given back to those individuals, plus a whole load of interest. The big question is, can they find another whole load of individuals, or pension funds, or huge institutions, or corporations, or whatever, or other governments and their own sovereign wealth investment funds who are willing to take on this government debt? And if the answer is not, then there's a crisis. Now, in the past, there was another way that governments could get out of such a mess, and it was by allowing confidence to fall in their economies, and then there would be a run on their currency. People would sell that particular currency, and the currency might fall by 10 or 15 or 20%. As a direct result, in proportion to the rest of the world's economy, the wages of those particular country workers would fall by 10, 15 or 20%. The price of all their goods that they export would also fall by 10, 15 or 20%. So eventually there would be a self-correcting mechanism. The wages would fall, the costs would fall, their sales would start to increase, until enough people were buying that currency that the currency started to return back to some kind of normal value. And so these things balanced out. But in countries where their currencies are fixed, that is to say within the eurozone, there is no depreciation of that currency possible unless the whole of the euro was to devalue by the same amount. And of course, since the countries themselves within the eurozone have very different situations, it was too much to ask that there would be a eurozone currency devaluation that would somehow be a perfect match for every single member of the eurozone's own financial needs. So if you can't devalue your currency in order to make the cost of your own products and services fall, to get yourself lined up again and stimulate things, what can you do? Well, one of the only other things you can do is just hope for the best. If you just hope for the best, then jobs start disappearing. As unemployment starts to rise, then people feel the squeeze. Harder the job market, the less people are willing to bargain for extra pay rises. Pay starts to fall. But the moment that happens, you get a deflating economy. And if you get deflation, what that then means is people's salaries fall in relation to their assets, the loans which they hold. It means that maybe their house prices fall below the level of the loans which they owe. So then you have the makings of another catastrophe where people are not wanting to spend money because they think that the longer they keep the money under their bed or in a corner of their cupboard, the more valuable it will be, because if prices fall, then the longer I wait before buying anything, the more things I can buy. So people stop spending, and those that have got debts start worrying. Those that are owed money start worrying hugely because they think that they'll never get their money back. So then you get banks starting to recall loans, repossessing houses, and the economy can easily go into free fall. So that's a very, very tough way to manage an economic crisis. But that's just about the only recourse for a government who can't devalue. The only other thing they can do is pump money into their own economy and hope for the best. So a government could, in theory, start buying up assets, buying up companies, buying up labour by building big public sector projects, buying up property, buying up just about anything, buying up its own debt by printing more money, whatever techniques it wants to use to try and put money back into the economy. But you can only do that with money you've got, and that means money you've borrowed if you haven't got it. And as I say, that then sets off a further chain of anxieties about whether those debts will get too high, and it can be a self-fulfilling prophecy, because if those who lend monies to governments start worrying that their money is not going to come back, if they then start demanding a higher interest rate to buy that government debt, then of course they can quickly force a situation where they do the sums and they say, well, the government could probably afford to pay that debt if the interest rates on it were only 5 or 6%. But now, because of the worries there are in the market, the government's going to have to pay 8 or 9% maybe to get people to continue to buy that government debt. And for sure, we've done the maths, and 8 to 9% repayment rates just aren't going to be possible without the government sliding into further chaos. And then the final part of the story is that governments then wake up, they realise they've got to cut all kinds of stuff, cut way back their stimulation budget, way back to normal, and then beyond normal into an austerity budget, and then risk all kinds of civil disobedience on the streets at a time when the government is in free fall in terms of morale and confidence in it, and also in free fall economically, unable to service its debts, a free fall in terms of confidence of investors in that particular government's capacity to lead without some kind of a social revolution, chaos, selling of government debt, and potential bankruptcy of that government, default on its loans, and the government becomes as bad a debtor as someone who fails to pay their mortgage repayments on time and lands up with the house repossessed. Except, how do you repossess if you're owed a lot of money by a government? The answer is, what assets do you ask for in return for your debt? The answer is, you're probably not going to get it. And that means very big risk. So those are the unfortunate situations in which some of the European economies now find themselves. And what's the way out? Well, one way out would be for the European Union to function as one big country, and for the wealthier countries to accept the risk and to bail out the weaker members for the sake of the community as a whole. Now that's asking an awful lot, unless those wealthy countries can be absolutely sure that the weaker economies are going to sort themselves out. But if the weaker economies are experiencing riots on the streets at the same time as saying that they're going to make further cuts, then you have to ask yourself whether the governments are going to be able to fulfill on the promises they make to the stronger governments in the European Union. So that's a big worry. So a further option would be to allow some countries to become effectively bankrupted and fall out of the European Union. But that's also a huge challenge, because these governments have banks within those, under their jurisdiction, who in themselves are carrying huge debt to banks in the wealthy countries. And this could set off a further chain of chaos that could drag down even the most prosperous and stable countries within the European Union. So it will require great skill, determination, solidarity, and political diplomacy in order to find a way through. And we will find that that process will take a number of years, at least 2 or 3 years, and I'm talking now in December 2010, before we will know whether the European Union is managing to find itself back on a route to economic stability.